Welcome to episode 4 of The Compass. We're recording this on Monday, August 12th. So there's some interesting news out there following in from episode 3. So if you remember in episode 3, we talked about it's a big M&A and the impact that's having, that can have. And we saw another transaction this morning with Osisko being taken out by Goldfields for another $2 billion all cash transaction. So it's more capital that has the potential to be recycled in the space, which is certainly a good thing.
Yeah, and the original plan for us today was to follow up on some news from last week, predominantly the Arizona Sonoran new PEA that came out. But obviously, we can't ignore the big news this morning. Osisko, we didn't mention it on the takeout candidates because we thought it was already too linked already with Goldfields, but certainly more than welcome to see this type of a takeout. And just a few points to mention. This is about give or take a 7 million ounce deposit, including being third. But it certainly has upside at depth. The type of upside that you are not going to drill from surface. You will drill that later on as you continue. You start developing the underground. So be mindful that this is not going to be just 7 million ounces. Well, in all likelihood, Goldfields is going to be operating that mine for a very long time. It's certainly welcome news for Canada, for Quebec. We did mention Troydos last time around, which is nearby. And again, to rehash the theme from last week, this is going to be another big one in terms of dollars being recirculated, recycled back into more of the juniors that we hold and that we know a lot of you viewers also are invested into.
Yeah, absolutely. But I guess back to the topic at hand for today and what we've planned to talk about. With every investment that you hold, you're always reevaluating every piece of news, every change in the market. You're always looking at going, does the thesis that I held on this investment still hold? And I think that's a healthy conversation you need to have with yourself or with your, in our case, Sam and I have that conversation together. And one of the major pieces of news that can come out, especially with development stage stories, are economic studies. There are multiple types of economic studies, PEAs, PFSs, feasibility studies, bankable feasibility studies. And those, yeah, go ahead.
Would this be a good time for you? You know more about this, but the two main studies that we typically talk about are PEAs and PFSs, pre-feasibility studies, but there's a big difference between the two. And we maybe give us a quick differentiation between the two?
Yeah, the first is the level of confidence. PFS is the level of work or engineering work that has to be done is much higher. The requirement is much higher to get to a PFS level. Things like metallurgy, etc. The major difference that everyone will see is that PFS produces reserves, whereas a PEA won't. And the big difference is that everything that's used in the PSF has to be in the measured and indicated category. So the difference between measured, indicated, and inferred is just really statistical confidence, which really comes down to density of drilling. So oftentimes what you'll see is that, and in the case that we're going to talk about with Arizona Sonoran, there's actually a big spend required to get to the PFS level from the PEA that they just put out because they have to go infill the inferred material that they've included there. So those are the two major things. And then obviously, the third study, PFS leads to a feasibility study, which is the next level up. I think slightly more higher confidence than a pre-feasibility study. But I think the key thing that's important here is there are, none of these are actual, to build engineering studies, right? They're engineering studies, but they're engineering studies on a more conceptual basis with quotes. They don't have detailed engineering done. And so oftentimes there's always variance to when the ultimate thing happens. And part of the reason you see, I guess, Capex increases is that oftentimes they're framed in the best possible, to put it bluntly, they're framed in the best possible light, particularly PEAs. PEAs have a margin of error, are supposed to have a margin of error in the plus or minus 20%. I think it's plus or minus 20% range. So you can get a big, 20% is a big variance when you start talking about, if you're talking about $500 million in Capex, that's a $100 million variance that you get on the other side of that. So those are big numbers in context. So for us, and the reason that this came about is that in episode 2, we spoke Arizona Sonoran, a company that all holds. And so literally, last week the PEA came out. Obviously the market reacted favorably to it, which we're happy about. But we had to sit down and reevaluate that investment, and based on the PEA and what we thought of it. Obviously the market liked it, the stock moved up, but we had to do our own evaluation. Is there still room for growth? Does it change our view on M&A? How does this fit with our investment? And so the one thing I will say about, and if you're looking to learn about studies and see what kind of information is presented, Arizona Sonoran does an exceptional job of presenting the information. As far as the presentation that they have that shows all the details of the study, how it compares to other things. I mean, that's very exceptional. Most what I say is most companies don't do that, but also most companies don't have the resources to do that thoroughly and that efficiently.
Great. I guess I just wanted to go back to the point where you said that this is a good time to reevaluate investments, not just for us as investors, but it's also the companies put a lot of effort into preparing these studies because it's obviously their internal guidelines as to what they're trying to achieve and where they're trying to go. In this particular case of Arizona Sonoran, if you go back through history, there is a pre-feasibility study that predates this PEA. That's not the logical sequence. The PEA typically goes first, then you scale it up to a PFS and then to a feasibility study. In this particular situation, there was a company-specific requirement to have a PFS produced at a certain time. We now know from this PEA, and we're going to get into the details, that PFS did not incorporate a big part of the resource that they've been drilling. So in a sense, we had that PFS, but this PEA supersedes that in many ways. And as we will talk about later, there's going to be a new PFS produced on this basis of this PEA. So it completely, let's call it like supersedes all the studies that were produced in the past. And then to the point that I wanted to mention is, these are times when companies can provide investors with a quite significant amount of information for their own internal studies and deliberations. And Derek and I went through this last week, Friday. We're just going to share with you some of the key concepts that we identified that we think are important and how they affected our decision making in terms of the investment going forward. And I guess maybe should we start with the big headline numbers?
Sure. Yeah, I think I spent when I was a research analyst, you spent a lot of time evaluating studies, right? And the big thing, there are two, I guess, sort of big things when you look at the numbers. We'll talk about some of the big numbers, and we'll talk about some of the smaller numbers, and then we'll talk about a little bit market perception. But the big thing is how those numbers compare to, in this case, the previous PFS. Those are things that are often crucial, and then also how they might compare to market expectations, which is a little bit grayer and a little bit harder to understand. But it's definitely something you need to sort of take into account as you do this. So I guess the big high level numbers are NPV, the NPV8 and the IRR. NPV8 came in north of $2 billion. You had 24% IRR. Those are just for reference, I almost always refer to post-tax when we talk about numbers. Turns out tax, certainties are death in taxes. So anyone, looking at the pre-tax numbers is sort of a pointless endeavor. Unless, the pre-tax numbers only matter potentially to corporate buyers who have significant tax pools. Other than that, it's always a post-tax basis that matters. So I think notably on the IRR and the NPV8, those are big increases, right? If you look at the PFS that was released in February versus the PEA, there's only $500 million on NPV8, same copper price, $3.90 a pound. And the IRR was 15% on a post-tax basis. Now we went north of $2 billion and 24%. Those are material jumps on the project. And I think the concept there is and I guess maybe on Arizona Sonoran and how we're looking at it, they went from having an open pit underground concept in the PFS to effectively, there is a piece of it that's underground, but it's effectively almost all open pit now because of this discovery of the mainspring deposit, and that allows them to be entirely open pit. So it's a fundamental change in the project. The other thing I always look at, and this is important, is the metal price assumptions, right? There's it's important in two aspects. One is always the primary commodity. Obviously, here they're using $3.90 a pound. That's pretty reasonable. Generally speaking, QPs make you sign off basically sign off on the 3-year trailing average. You don't usually get spot. You can get spot to show an upside case scenario or something like that, but generally you got to have that. You usually get in a rising commodity price environment, you usually have a lower number. For us, that gives a good frame of reference. Obviously, there's some downside protection because you have some room in the commodity price here. The other thing to think of, the other thing to watch is where previous studies were done, right? So there's a big twofold impact. So in this particular case, Arizona Sonoran did both studies at $3.90. They're 6 months apart. That actually makes perfect sense. But if the previous study is at a lower metal price and then this is at a higher metal price, what often happens is it makes lower grade resources and reserves economic, right? It can change the nature of the project in a slightly different way. I really like this apples and apples comparison because it gives a very clean picture of that, of those numbers.
So those are the big headline numbers. I think the other key number that's important to look at is kind of like initial Capex figures and how that compares to the NPV8 of the project. I think in this case, the total Capex is in the $600 million range. The NPV is just north of $2 billion. The magic number that a lot of investors look for is the 1-to-1 ratio. In this case, the NPV surpasses the initial Capex by quite a margin. It's actually multiples of the initial Capex. That's important, particularly when you're thinking about a takeout scenario, because conceivably you can imagine a new buyer looks at this study and they say, okay, I'm going to have to put 600 million plus into the Capex, but I also have to buy the project from the company, which is going to cost me anywhere between 100 million and a billion, somewhere in there. And so how does that relate then to my return after that acquisition? I think in this case, the great news is that you do have that multiple on the NPV relative to the Capex, which is not as common as you may imagine. Most projects fall somewhere above or below the 1-to-1 line. It's not usual that you get multiples of the NPV to be a multiple of the Capex. And so I think that's one of the key elements that has had a very favorable reception from the market.
Well, and I think also if you look at if you go take that back to the prior study, right, it was a 1-to-1 ratio. So Capex went from 500 million to 600 million, roughly. But the prior NPV was 500 million. So you had a 1-to-1 ratio, and now you have a kind of almost a 4-to-1 ratio, 3.5-to-1 ratio, right? So a big leap from that perspective on that ratio. And it's something, it's not really there's no real true metric. It's effectively margin for error, right? But I point out on the takeout side, that actually matters, right? If you got a 1-to-1 NPV on a project and you have to buy the company, it makes the takeout scenario a little bit harder. It's interesting, when you think about it, what drove, what I always look at, okay, you see these big changes in the headline numbers, right? You think, well, what drove that? What drove that change, right? That's always because what you don't want is, they've moved the metal prices. We talked about metal prices already, or they've taken some shortcut somewhere else, or especially now because in this particular case, you're going from PFS to PEA, so you went from a higher confidence study to a lower confidence study, and so you want to okay, what did they do? So you look at you always look at some of the smaller, they described it, just talked about the big numbers, the headline. So you dig into the smaller numbers. The ones that jump, ones you look at, people always look at cash costs and all-in sustaining costs. They're roughly the same. I don't think that there's not a big gap in those. $1.80, they're both in $1.80 range, probably within the ratio. $1.80 on C1 cash costs, and then $2.30 and $2.20 on all-in sustaining. So no real change there. So obviously and I suspect they've used some of the inputs that they used in the PFS that they've generated for the PFS into this PEA. So it's probably got a little bit better confidence than your typical PEA. But I think the big changes are not throughput, but production rate and mine life. Now, mine life doesn't really affect NPV and IRR because we're talking about going from 20 years to 30 years. But the big gap was actually in production, right? They went from 55,000 tons per annum on average to 86 over the 31-year mine life. But if you over the 20-year mine life, it's 100.
Loaded. Yeah.
It's front loaded to 115. And this is a game that companies play, but it's also something you need to keep in mind when you're looking at projects, particularly MPV. IRR, it works is similar, but with an MPV, the MPV of a project is a discounted cash flow model. And for anyone if you've never built a discounted cash flow model, they are basically effective up to about 10 years. Everything that happens at year 11 beyond doesn't matter. And so, the fact that this says, the 31-year mine life, the 10-year mine life extension, actually, although that is a really good thing, and when you think about it from an M&A perspective, something bigger companies look at, it's not something that actually matters to the headline numbers, those big numbers you talked about, the big increase in NPV and the big increase in IRR. What does matter is the fact that you're producing 115,000 tons per annum of copper a year versus 55,000 tons per annum of copper a year. And so that number makes all the difference.
If we go back to, I don't know if it was the first or the second episode that we made, that we sort of translated numbers into gold equivalents, because that's what most of us are used to for scaling projects. The first 20 years of production at this new project would be something in the range of 4 to 450,000 ounces of gold per year. So you're already pushing scale-wise. You're really pushing into that tier one area where bigger companies, tier one companies, the larger global players would be interested from a scale perspective. And we're going to talk about that a little bit more when we talk about what this means for the future of the company. But just to put it in context, that's about 4 to 450,000 ounces of gold per year equivalent. The other thing that I wanted to highlight here is that, and they did a pretty good job in their presentation in the webinar where they presented the results of the PEA, is this will make this project the 5th largest copper mine in the USA. So you're already in the higher echelons of the Freeports and the Rios, who are the dominant players in that market. That also, and I can't remember exactly what the order was, but this is something I think it's just behind Baghdad, or it already started playing amongst the larger players. The other thing they did a pretty good job about on putting out the details is they did a very nice comparison with other projects of a similar development stage, including Filo del Sol, amongst others. And the project shows very positively and solid when in comparison to these projects. Now, companies have the ability to pick and choose what they compare the project against. But I think in this case, they did a pretty good job of the higher end of the copper projects that are available in the market, including Filo, which we now know is no longer available. But the project shows very well in comparison to those projects as well.
Yeah, I think that's a key thing. The other thing you want to look at, particularly in these studies, is always metallurgy. You don't get the detail. As a metallurgist, I gravitate toward things like that, but it's something to watch, particularly in PEAs. You don't have to do a lot of rigor in metallurgy for a PEA, and that is always a concern. Now, in this case, Arizona Sonoran has done a PFS. I don't think they haven't done PFS level work on Mainspring, which is the deposit that got added that sort of made this transformation. But everywhere else, they've done PFS level work. And, generally speaking, when deposits are next to each other, generally speaking, and I do caveat that very carefully, they have similar metallurgy. And so I think you're going to see that's something they have to do, the PFS level work, but to get to do the next PFS, I guess, if you will. But I think that is a something that you always keep an eye on, and the level of test, not just the what the number is, but the level of testing. Oftentimes you don't get that to the 43101, but it's an important element.
That's an important element for all technical studies, but I think in the case of Arizona Sonoran is of particular importance because the baseline metallurgical studies that they use for the PFS, that presumably they've lifted and used for the portions that are comparable in this PEA, are for traditional technologies. There is a big caveat in this story, which is that Rio Tinto, through a subsidiary, a technology subsidiary called Newton, has an investment and a sort of agreement with the company pursuant to the success of a new metallurgical technology that they've been testing. And we are expecting the results of those metallurgical studies now Q3, I think, end of Q3 of this year. Like Tristan says, that's tomorrow morning. And that could materially improve the project and the economics, in particular when it comes to the sulfides, where they're using very conservative, in my opinion, that's an opinion, not a fact, they're using very conservative recovery assumptions. If you can prove that this technology can enhance those recoveries in an economic way, not only are we going to get more economics, but also higher volumes of production, which would translate higher NPV, higher IRR, and overall an even more attractive project than it already is.
That's an interesting point in this one, and it's an element of always once a study comes out, the question always is what's next, right? And when I was a research analyst, I would ask CEOs that. They would kind of look at me funny, be like, I just put out this massive study. Can we enjoy that? I'm like, well, it's how you get there, right? The market trades on expectations, not on thing. And I think that's something I want to just cover very briefly in this case, and then generally speaking, right? There are two ways that the companies communicate the expectations for the study, right? They oftentimes you can get pieces of information out in informal ways, whether it's metallurgical results. Oftentimes with a resource you can see they'll have pitch shapes and they'll made assumptions on metallurgy and things like that. So you can if you know a little bit about and then make assumptions on cost, provide assumptions on cost, so you can start to set expectations for what a PEA looks like. And if you know what projects typically cost, then it can fit in. The other thing is that what management says, and obviously not everyone has access to speak to management one-on-one. I encourage you. Well, many companies are very accessible, and Arizona Sonoran is generally very accessible. But they frankly reach out and call. They'll, generally speaking, the IR person, the CEO, should get back to you, and if they're not, that's a side in and of itself. But they also, they're in this day and age where there's a lot of webinars and video content and presentations. Every time a company gives a presentation it's recorded, it's out there in the market, it's out there for you to watch. You will be able to see some of those things as to what the expectations are. And I think the perfect scenario is under promise, over deliver. And I think that's what, in our communications with Arizona Sonoran, I think that's what they did here, right? They kind of said, this mainspring thing is going to change the project, right? It's going to make it better, but they didn't say 5 times better, 4 times better, which is what it actually delivered. And so I think that's why you got the positive surprise in the market. But so then they effectively exceeded market expectations, which gives you the positive return on the share price on the day the study goes out, which then gives you the impression that it was received favorably. Oftentimes, if management is too bullish on the study and then the study actually comes out, you can be even though it's a good study, the market might go down on that day. And so it's a thing. So what people are expecting it matters a lot for these projects.
Yeah, and I guess in terms of us evaluating our investment beyond going through the numbers here and interpreting what they mean to us, and going back to what you said about what comes next, they made it very clear what comes next. This quarter, towards the end, they're going to get the Newton metallurgical testing results. They are currently infill drilling the mainspring deposit so that they can be included in a pre-feasibility study. They're going to incorporate the existing work and these 2 results into a new pre-feasibility study to come out sometime in the first half of next year. They did guide towards the summer part of the first half, so think about June. So that takes us roughly 12 months from now. I think at that point, the company is going to be in a position to perfectly illustrate what this project could become, including the results of these new metallurgical studies, whether they work or they don't. So that's something that we use to evaluate our investment going forward. And I guess for us, this project has graduated from a tier 2 to the very high end of tier 2 and the bottom end of tier 1. I think scale wise, it is starting to push towards tier 1. Jurisdiction is definitely a tier 1. This is an old mine, so a disturbed site. which is something I'd like to see now that permitting is so paramount. It sits on private land. So on all those matters, I give it a tier one. And so it is certainly a project that deserves attention. When we look at the valuation, I think there is substantial upside opportunity for investors today who are participating in it, like we are, and ultimately, I see this as a taker candidate next year when they have run through the course of the PFS, of the full PFS. I don't know. What do you think there?
Well, I mean, I think on the you and I had this debate as to where it fell, tier one, tier two. The more work I've done, the more I'm leaning towards tier one. Although this was always sort of a mid 50th percentile type project for me. Had some really good elements, but also had some, it's not the lowest cost, not the highest grade type project. I think it's worked its way into that, and it's the scale aspect that I think's changed a bit here. It makes it much more attractive in tier one, and so I think it's material, and I think that's the opportunity. I think it's materially undervalued here. As far as the takeout side of it, Rio's via Newton has an option to earn into a significant portion of this project. To circle back to the beginning of the episode, talking about Goldfields and Osisko, right? Goldfields was already in the project, and then just kind of put the corporate entity out of its misery. I think that is something, that is a possibility if the Newton technology proves to work, which initial studies have shown that it is working. The Newton technology proves to work. There is a natural buyer. And if you look at the structure of the payments that Newton/Rio would have to make at the end here, her expectation would be that they wouldn't make the payments. So I think that is certainly a possibility. But I think also you have a really good project in a tier one jurisdiction, and that's undervalued. And so I think it checks a lot of boxes, and it certainly has a management team that we have.
That's one thing we haven't given enough credit. This episode is that, and we mentioned on our investment criteria, people is criteria number one. This company has phenomenal people working for it. George Ogilvy, the CEO, trail of success in his past. He took on this project early, and through the iterations, his team have obviously delivered now a $2 billion plus NPV. So having raised not a lot of money, which is, I think, an important factor here. This is not a $2 billion NPV on $1 billion having been invested in the project. It's multiples of what has been invested to date in the project. So this is one where we quite like the people involved. We like the communications. We like the people they have working on their investor relations. And I actually encourage everyone to go on, if you haven't yet, go through the presentation where they presented at PEA. I think that should be an example for how to present this type of studies for other companies. It's as clear as it gets. And kudos, to showcase that point is at the end of the webinar, there were very few specific questions because they had covered so much already in the presentation alone. So yes, this is something that the management here is something that we really like.
This has been 29 minutes of us going from, okay, this event occurred, we reevaluated our investment. What was the conclusion of our process? So just for reference, we did have a position, and I don't know. You described that as a mid-sized position for us. Wasn't a large position, but certainly wasn't small. And I think we've been our view is we've been buyers. We don't give this that type of information, and I think that's at select levels. We didn't certainly weren't top ticking at $1.75 on the day after the study came out, but I think that's that's reflective of the study, and that we're increasing our size of our position because we think that this is the study did a good job and moved it out.
And when we look at the comparable opportunities on a per pound basis, this screens very well, and that together with the Capex to NPV multiple, we think there is a substantial amount of room above these prices for a future takeout at a much higher price. And looking in particular at the Rio case, If the Newton process works, they're contracted to make certain investments into the company that are substantial. And for a company like that, with a project that proves to work with their new technology, and already having committed to fund a big portion of the development, and we think there is a natural path and for a sale of the company in the future at a price that should be materially higher than what it trades today. Just on a comparable basis alone, it's trading at a fraction of similar projects. So that's something that gives us comfort. Together with the, I would like to say this, like we like to invest in management teams that we know they're not going to do anything stupid. We have great confidence in this management team to deliver fantastic results, not just on the ground with these types of studies, but also when the right time comes to make a decision to sell the project or the company. So with that, I guess we decided to increase our holding in the company. We started buying as soon as the market opened. I don't know if it was Thursday or Friday. I can't remember if the study came out on Wednesday or Thursday. But anyway, the morning after it came out, even before the webinar, we were out there in the market buying. And yes, we like it, and we are increasing our position.
All right. With that, if you agree or disagree with us, love to hear it in the comments. I know that there are people who do disagree with us, so we look forward to those comments. And with that, I think we'll wrap up episode 4. Thank you very much for taking the time to watch.